Colescott is a second-generation, 25-year industry veteran in the closed-end fund, business development company, and interval fund landscape. And he has been with CEF Advisors since 2001 and is also the founder of the Active Investment Company Alliance. Welcome, John. You bring such a unique and multifaceted perspective.
It's always great to be here with you, Jane.
Yeah, great to have you back. So let's start with peer active ETFs and CEFs. So what does the data show about those two and what makes them useful and challenging?
Yeah, so closed-end funds have traded here in the New York Stock Exchange since 1893. ETFs have been gaining a lot of interest for a lot of investors, as you probably know, and our audience should as well. And we thought it'd be really interesting in today's environment as closed-end funds, some of the sectors have gotten kind of tight, and ETFs have really grown in the active space and a lot of more sectors than just traditional stuff we saw 10 years ago, Jane. And we even at CF Data, we've added a 250 ticker symbol ETF data file with over 150 data points, really talking about where you might plug in ETFs when you're a closed-end fund investor. And we argue where you might want to plug in closed-end funds if you are an ETF-focused investor.
So let's explain, when would somebody want the closed-end fund versus ETF? Why would they rotate in and out?
Great. So both structures are very similar. The major difference is that you can have a disconnected market price for a closed-end fund leads to a premium or discount. And then because most closed-end funds offer leverage, you can often usually enhance that yield. And so basically you often can pick up discount tailwinds as a closed-end fund investor and more yield per kind of risk at the manager level. And then ETFs, you can't get any discount headwind or tailwind, and you generally get less yield for the same type of investments, but you can often get good yield in this market because active management has brought a way to do some really interesting work in different sectors that can compete or be a companion to closed-end funds.
And you also just added an ETF companion file with the data you briefly touched on. Elaborate on that a little bit.
Yeah, so we decided that in our portfolios for income-focused clients at CF Advisors, we wanted to be able to, when the closed-end fund discount got narrow, be able to swap to something and maintain asset allocation and also most of the yield pick up. We also thought that, there's a chance to have those positions sitting and waiting for the next time discounts widen. We never know when they'll happen, Jane, but days like today, where you've got some interesting news items, on the Friday in August, we're considering maybe discount widening to be a place where then you can take those no discount, generally ETFs, and find fatter discounts in closed-end funds, and rotating your income portfolio through an allocation to closed-end funds and through an allocation to ETFs based on your basis is a great way to potentially pick up some reduced downside, possibly make up upside, and maintain similar yield in many environments.
And then you've also have some information on two credit sectors. So high yield, right? And also master limited partnership. So
first we've got high yield. And so there's an ETF there. That's the iShares High-Yield Active ETF. Ticker symbol is BRHY. It's a small fund, but iShares is a large complex. So it's just over $60 million. Get no discount generally for ETFs. We have a 6.5 yield roughly. And there's of course no leverage for that fund structure. And so the manager has hit 6.5 to give you the investor 6.5. And the 1-year NAV total return is about 10%. And expense ratio, common for an active ETF, is 45 basis points. So that's a fund that you may be comfortable with in this space if you're an ETF investor. The kind of similar companion closed-end fund is DHF, and that's the Bank of New York Mellon High-Yield Securities Fund. It's only about $300 million in assets, but it's almost a 7.5 discount right now. But its discount swing the last 5 years has been from -16 all the way to a +9. And its yield is 8.2, but the cool closed-end fund thing is with that 27% leverage, you're able to only need 5.9 to fuel that 8.2 because of that closed-end fundiness general benefit. In the last year, the net asset value has been close to the other fund, but 9 and mid-change. But the expense ratio, of course, is a little higher, 1.27. And we thought it'd be fun to look at another sector in the credit side. It's the preferred equity sector. And so there's a Nuveen NPFI. It is again, smaller fund, but Nuveen's a well-known player to the closed-end fund viewers that we have. It's about a 5.6 yield and about an 8.6 1-year NAV performance and a 55 basis points expense ratio. Let's look at a really well-known old closed-end fund in the space, the FFC. It's the Flaherty Crumrine Preferred Securities Income Fund. It's a $1.3 billion fund. It's at a 6 discount. Its 5-year range is from like a -15 to a +15. We've had an interesting 5-year period, as you know, Jane, and it's giving you a 7 yield, but with 37% leverage, it only has to do 4.7 to fuel that. And the 1-year NAV performance has beaten the other fund because of the leverage, we believe, at 11 and change. An expense ratio, this might surprise people when you back out leverage cost and over net assets is 91 basis points. And so that's the type of funds that can be companions. If the closed-end funds are narrower, you can buy the ETF, and then when they widen, you can rotate the ETF back to the closed-end fund.
Now, what about expenses with those, volatility?
So great question. So we hear a lot of people talking about volatility in closed-end funds. They go, oh, it's because they're levered. And that does add some NAV volatility. But the bulk of closed-end fund volatility is simply the fact that you can buy and sell it at an elastic disconnection towards net asset value. And that would happen whether they're levered or not. And so we find, when we talk to our clients, and we think investors should consider volatility not just a risk, but an opportunity. Because what you want is a more volatile discount so you can sell when it's overtly high and buy when it's overtly low. And that's a great way as a retail investor to do type of investing that the large institutional owners of closed-end funds often do for their clients in very mass scale in a personal way for your portfolio.
Yeah, volatility equals opportunity sometimes. So how have those performed for sectors?
Yeah, so I mean, sectors, we never know the future, Jane, but we basically as CEF advisors consider our forecast for interest rates, our forecast for employment, and try to build a durable portfolio of income for our clients that's tax thoughtful. And so like preferred equity is going to be a less robust sector, more defensive. You know, it's basically higher in the capital stack of a company. And so it's generally safer through bankruptcies or other problems. And of course, high yield, you know, some people call it junk, but we prefer high yield because, you know, it's just less quality investments, but with active management, we believe whether it's the ETF wrapper or closed-end fund, an active manager can make diversified bets to give you these higher yields with less idiosyncratic risk by having hundreds or even thousands of positions, depends on their fund.
Okay, interesting as always. Thanks so much, John.
Great to be here, Jen.